let's begin with S corporations. Okay, S corporations have some similarities to a C corp and a partnership. The way that the income flows through an S corp is more similar to a partnership than it ever would be to a C corp. A C corp is not a flow-through entity. An S corp is. There are benefits to an S corp, and there are also drawbacks. A C corporation and an S corporation gives liability protection. The big benefit of an S corporation is that you do have liability protection, and then you have the flexibility of taking distributions as well as wages. Okay. They do have drawbacks. They are less flexible than partnerships. There are a few instances when an S corp is forced to pay tax on its earnings. When I started on this, I didn't understand why that was. And the only time that that actually happens is, I mean, an S corporation can have employees, like you can hire a receptionist to work for you, being an S corp, and then of course you owe payroll taxes. But an actual tax, like a C corporation has to deal with, doesn't really happen with an S corporation unless it was a C corporation before and it became an S corporation. So the only time an S corporation is going to be taxed on its earnings is if it was a C corp and it has some residual stuff going on from when it was a C corp. Okay, and we'll talk about that because that's been on prior tests. There are restrictions on the number and type of shareholders that an S corporation can have. That's really important because one of the things that we always talk about as tax professionals is an inadvertent S corporation termination. Because what happens when you break the rules when you're an S corp is that the IRS you become a C corp on the day that you break the rule. And that causes all kinds of drama and craziness, and people get very upset about that. Okay? And it happens a lot, actually. Okay? So an S election is made on Form 2553. The S corporation files 1120S. So a C corp is 1120, an S corporation is 1120S. Okay? The income flows through to the shareholders on Schedule K1. So it's the same schedule number name as a partnership. Like the only difference, basically, is that at the top of the form, you see Schedule K1, Form 1065, or you see Schedule K1, Form 1120S. That's really the distinction. Beyond that, there's not very many. Like a partnership, shareholders of an S corp have to pay tax on their share of corporate income, whether or not it's actually distributed. And this shouldn't be that confusing. If the company makes money, you're going to have to. If I have an S corp and my company makes money, I have to pay tax on the money whether or not I take it out of the bank. I mean, that makes sense, right? The idea is that even if I don't take a check, the IRS doesn't care, right, about that. They want you to pay tax whether or not the income is distributed to you. Okay? Oh, but I left it in the account. The IRS doesn't care about that. If you made the money, now with a C corp, if you have a C corp, if I'm a single shareholder C corp and I leave the money in the bank, then I don't get taxed on it. The C corp is going to get taxed on it, but that's not income to me unless it's distributed or I take a wage. All right? So my C corp can make money and make money and make money, and I never take a wage if I wanted to. The thing is that then the IRS comes in and says, why are you accumulating earnings? And then that's when the accumulated earnings tax comes in. So you're damned if you do and you're damned if you don't. But yeah, the S corp gives you a lot more flexibility in this respect. But if the S corp makes money, you're going to owe tax as a shareholder. All right. Okay. Requirements. There is no such thing as a foreign S corp. That does not exist. S corporations are domestic only. There's no such thing as a foreign S corp. They can only have one class of stock. This gets tested all the time. Most publicly traded C corporations have what's called common stock and preferred stock. That's what they have. There is no such thing as an S corp with common stock and preferred stock. You cannot have that. If you try to create two classes of stock, your S corporation election will be tanked. It'll be disallowed. So you can have differences in voting rights, though. So remember that little distinction, because that absolutely gets tested. So only one class of stock, differences in voting rights are okay. You can have no more than 100 shareholders. A husband and wife and their estates are treated as one. Now what happens if there's a divorce? They're not married anymore, right? So they're not treated as 100, they're not treated as one shareholder anymore. This is actually true. What happens if you're right at the 100 shareholder limit and one of your husband and wife shareholders decides that they hate each other and now they're divorced? You're not an S-Corp anymore. It's your S-Corp election is gone. You become a C-Corp, which is not good. They must have shareholders that are only individuals, estates, and trusts and exempt entities. Partnerships and C corporations cannot be shareholders. An estate can be a shareholder of an S-Corp because if somebody dies and they have S corporation stock, then the estate can continue to own the stock. Because the estate is not a business. It's somebody dead, somebody has died, and now their estate is trying to be settled, right? So the IRS doesn't punish the estate for being a shareholder, because a death is a sudden thing. It's not something that you plan. An exempt entity, remember, an exempt entity is going to be a nonprofit, so a 501c3. A 501c3 can be a shareholder in an S-Corp. Remember that, because that's one of these weird exceptions. That includes an exempt entity that's actually a corporation. If it's a nonprofit entity, it can own shares in an S-Corp. A regular C corporation that is not a nonprofit cannot, okay? Partnerships also cannot be shareholders in an S-Corp. Now, partnerships and C corporations can buy stock in a C corporation, that's fine. But an S corporation is prohibited. And if they actually do own shares, if something happens and a C corporation owns the shares of an S corporation, then this S corporation status goes out the window again, okay? You cannot have a non-resident alien shareholder. We had one case where this actually happened, and it's always because people don't know what they're doing. They don't know the tax law. It was a father who had a business, had a very successful business, and the son wanted to be like a partner with the dad, which is fine. The dad said, okay, and the dad gave him 10% of the business. So there was only two shareholders. It was the son and the dad. They went through all the legal rigmarole or whatever, and the son became a shareholder. Then the son took a trip to find himself overseas, and he met this wonderful woman in some European country. He married the wonderful woman and promptly gave her shares of his stock in the company, just in case something were to happen. Now, the wonderful woman who was overseas was not an American citizen or a green card holder. What has happened? The S election is tanked. And that was one we couldn't fix, right? That was a done deal. So on the day that the wonderful non-resident alien wife got shares of the company became a C Corp on that date, and the father was livid, very upset. Okay, profits and losses must be allocated to shareholders in proportion with each one's interest in the business. Now that's not the same with a partnership, okay? If Julie and I have an S Corp and she's a 50% shareholder and I'm a 50% shareholder, we've got to allocate profit and loss equally. Now, there's a little bit of leeway here, because if I'm doing more work than Julie, then I can pay myself a higher wage, right? But I can't say, hey Julie, I'm going to pay you $5 and I'm going to pay myself $100,000. You can't do that. But with a partnership, you can. Like, a partnership allows all kinds of flexibility with regards to guaranteed payments and allocation of income and loss and everything else. You just have to outline it in the partnership agreement. And S Corp doesn't allow you that kind of flexibility. You pretty much have to allocate the profit in proportion to each one's share of the business. Okay. Once again, I said, look, the wages gives you a little bit more leeway. I can pay myself a higher wage if I'm actually doing more work, but you know, there's not as much flexibility there for sure. Okay. Remember, an S corporation has to file its tax return on Form 1120S. It's going to be the same filing deadline as every other corporation, so March 15th. An S corporation, just like a C, is required to file a tax return regardless of any income or loss. That's not really a problem these days, right? Pretty much everything gets e-filed, but
Everybody e-filed now.
yeah, pretty much. Well, yeah, pretty much. An S corporation is usually required to use the calendar year. It's just like a partnership and a sole proprietor. They're all on the calendar year. It's usually January to December. There are some exceptions to that. They're kind of strange. There's something called the natural business year that it's common in some areas of the United States where maybe they have a growing cycle for crops, or maybe you have a business that sells like Halloween items or Easter items, and then you would want your natural business year to end on the date of that holiday or something like that. So you can request, the IRS calls it a bona fide business purpose. So if there's a ski resort, you know, they close for the majority of the year and then they're open 4 months when it snows. So you can use a fiscal year if you can establish a bona fide business purpose for that fiscal year. So if you have a bona fide business purpose that's related to the activity that you're doing, you can choose a fiscal year, but I'm assuming that you have to request it. There's also the ownership tax year. Now, the reason why this is in here, because, okay, so an S corporation can only have individuals basically as shareholders. What's the weird exception? Where a corporation can be a shareholder in an S corp? A nonprofit. Nonprofits are usually fiscal year. You guys know that, right? State agencies, all kinds of nonprofits, they usually choose like a fiscal year in June. So they'll usually end June 30th or something like that. It's more common for a nonprofit to have a fiscal year than a calendar year. So in the strange event that you have a nonprofit that is a majority shareholder in an S corp, then in that weird, narrow instance, you would have a situation where perhaps you would have a fiscal year S corp because the ownership of the exempt entity is a fiscal. So the tax year has to coincide with the 50% ownership of the corporation. So if the exempt entity is on a June 30th fiscal year and that entity owns 51% of the S corp, then you got to follow the fiscal year of the majority shareholder. I have never seen this happen in practice. I'm sure there's 1 or 2 examples on the planet where this actually occurs. But yeah, you guys have to understand that concept. There's also something called Section 444. Sometimes the IRS tests on this and sometimes they don't. You request to have a fiscal year that's like a couple of months different than a calendar year. It's called Section 444 request. And it's outlined in the book. It's a little bit odd. We don't have anything like this in our practice either. And it's when you request a tax year that's a fiscal year when in any other case you would be required to use the calendar year. And then you can also have a 52, 53-week year that ends with reference to a year listed above. But for the most part, an S corp is going to be required to use a calendar year because it's going to be individuals. So it's going to be me and Julie, it's going to be me and Patricia, it's going to be me and another person, or just me by myself. And of course, an individual taxpayer is always on a calendar year. Okay? Okay. But you got to know this weird stuff, because the IRS might actually test on this, and then you'll never actually see it when you're in practice, right? Okay. Okay, here's the bad stuff. This is when an S election is terminated. It usually doesn't happen because people want it to. It happens on accident. Although you can elect to terminate your S election and switch to a C corp if you like. An S election will terminate in any of the following cases: when the corporation no longer qualifies as a small business corporation, And that is when, for 3 consecutive tax years, the corporation has accumulated earnings and profits and derives more than 25% of its gross receipts from passive investment income. The only way an S corporation can have accumulated earnings and profits is if they were a C corporation before. If an S corporation is an S corporation from the outset, it is never going to have accumulated earnings and profits because all of the earnings and profits flow out to the shareholders. The only way you're going to have this problem, which is accumulated earnings and profits, is if it used to be a C corp. So don't be confused by this. You don't see this very often. But if sometimes a C corp will turn into an S corp, and then they don't have their stuff together. They still have accumulated earnings and profits, and that stuff's sitting in the books. That needs to be taken care of. Otherwise, after 3 years, the IRS is going to come knocking and say, hey, we've got a problem here. You're going to owe tax. Or we're going to terminate your election. Clean this up. Clean up your books. Get rid of all this accumulated earnings and profits. Distribute that. All right? So this only happens when it used to be a C corp. The S election will also terminate if you create a second class of stock. Cannot do that. The only difference in stock you can have is a difference in voting rights. Now, do you guys know what the concept of preferred stock is? Preferred stock? Preferred stock, I'm not like a stockbroker or anything, so I don't know a huge amount about it. But you have preferred stock and you have common stock. Preferred stock, a lot of times it's called preferred stock because preferred stock shareholders have the right to be paid first. Okay? So if the company has money and Julie has preferred stock and I only have common stock, Julie gets paid first. And when Julie is done being paid, then if there's money left over, then the common stock shareholders get it, right? So they get preference over payments. You cannot have that kind of a situation with an S corp. The S corp has to have all common stock, which means if Julie and I are in an S corp together, I get paid, she also gets paid. There's no preference for her or me. Does that make sense? So you cannot have a second class of stock with preferred payment or anything like that. The only difference you can have is difference in voting rights. Okay? Shareholders can willingly revoke an S election. An S election can only be revoked with the consent of the majority shareholders, so more than 50%. And this has been on prior exams. Not 50, it has to be 50.1 or 51 or whatever. It has to be over 50% of the majority shareholders have to consent. So if you have 4 shareholders, over 50, right? If you have 4 shareholders, Tim, John, May, and June, and they all owe 25%, this has been okay, which is 100% of the stock right here, of the shareholders. You've got 4 shareholders. Can Tim and John revoke the election? No. No. Tim and John have to get either May or June to agree. Because 50% is not enough. Okay? Remember that. They might ask you to do the calculation. And they're not going to give you an easy thing like this. It's going to be John has 10%, May has 5, something has 80. It's not going to be like very easy numbers like this, but they're going to ask you to calculate. And they'll say, Tim and John want to get together and revoke the S election. The other 2 shareholders don't want to. Do Tim and John have enough shareholder ownership in order to revoke? And then you have to do the math. Okay? So it's over 50%. Okay. Now, here's a situation where you go begging to the IRS to please not terminate your S election. If you make a mistake and you have a terminating event, like the husband and wife shareholder divorce, and then you go over the 101. If the shareholders did not plan to terminate the election, they sometimes can request that they remain in S corp, but you have to immediately correct the issue. The corporation must agree to any adjustments that are proposed by the IRS, and the corporation has to request a private letter ruling for any inadvertent termination relief. So it's not as easy as just writing a letter. A private letter ruling is not free. A private letter ruling costs money. You have to request it from the Internal Revenue Service, and pretty much if they say nope, then it's like tough beans for you, okay? So you have to request a private letter ruling, you have to go through kind of a process, and you have to formally request termination relief, okay? Okay. If the status of an S corporation is terminated, either because the shareholders elect to become a C corporation or because of a terminating event, such as the shareholders exceed the maximum of 100, the S corporation cannot elect to become an S corporation again for at least 5 years. The IRS may choose to waive the 5-year restriction, but the IRS has to actually give you permission. So this 5-year restriction applies both ways, and you have to remember that. Sometimes the IRS will give you a question, because 5 years is 60 months. You guys know that, right? For anybody who's ever taken out an auto loan. 5 years is 60 months. So sometimes they'll tell you the number of months and you'll have to do the math. When is the earliest that blah, blah, blah can elect again? And one of the former questions, one of the old questions that they had was shareholder elected to become a C corporation. They were an S, they elected to become a C. And then a year later they had like remorse and they want to go back, right? How long do they have to wait? They have to wait 5 years to request to go back again, which they can do, but they have to wait 5 years. The easiest thing to do in that case is just close the corp, right? Start a new one and close it down. Okay, limited taxation of S corporation. So this is what I was talking about earlier. If you have an S corporation that used to be a C corporation, then you have this stuff. Built-in gains is actually called the big tax. I don't think you're going to be taxed on built-in gains, but it's something that CPAs talk about all the time. It's a tax that affects C corporations. LIFO recapture, investment credit recapture, and excess net passive investment income. This happens, they might have to pay income tax. This is the only time that S corporation has to pay income tax on its earnings. So when it has this stuff going on. None of these taxes are going to be deductible as business expenses by the S corporation. Now, an S corporation, income tax and payroll tax is not the same thing. So an S corporation who has employees might have to pay payroll tax, and they might also have to pay penalties for late filing. So there's penalties if you don't file your S corporation return on time, even if there's no income tax on the S corporation. So that's a situation just like a partnership. A partnership is a pass-through, but if you file a partnership tax return late, you're going to get a bill. Okay? All right. Distributions. S corporation distributions are generally not treated as dividends and not subject to income tax, unless an S corporation has accumulated E&P from the years back when it was a C corporation. If a taxpayer has a distribution that is more than the basis of the stock, it's going to be treated as a capital gain. So what ends up happening is if you have distributions that exceed basis, which doesn't happen very often because how are you going to distribute money that you don't have? But if you have a distribution that exceeds basis, the distribution is treated as a capital gain, and it's reported to the shareholder on Schedule D. So here's a situation where the distribution exceeds basis. So Lucinda is a sole shareholder of an S corporation. Her basis at the beginning of the year in her stock is $25,000. Okay, pretty straightforward. At the end of the year, she receives her year-end distribution of $28,000. That reduces her basis to 0. Okay, so she started with 25, but the corporation gave her 28, which is fine. Yeah, that reduces her stock basis to 0. So January 1st of the next year, her stock basis is going to be 0. She's going to start with a 0 stock basis. And then she has to report that excess as a capital gain. Okay? So you don't have a negative basis. There's no such thing as that. You can't have a negative partnership interest either. What ends up happening is there's repercussions, and she has to report that as a capital gain. Okay, reasonable compensation. Now, when we talked about C corps, we talked about unreasonable compensation. The opposite is true for S corps. With the S corp, the IRS is always looking for you to have reasonable compensation. So with the C corp, you're paying your shareholder too much. With an S corp, you're not paying your shareholder enough. That's exactly what happens. Okay? So an S corporation who is not paying a reasonable compensation to a shareholder employee, what ends up happening is the IRS steps in and reclassifies the distributions as wages. Happens a lot, actually. An S corporation will be at risk if it attempts to avoid paying employment taxes by having its officers treat their compensation as distributions, payments of personal expenses, or loans rather than wages. And all of that happens too. These are all abuses that are very common in the S corp world. One of the more recent cases that happened was actually an accountant, and it became kind of a landmark case because the IRS won, and I bet you they went back to the office. They were like throwing confetti and everything. Ah! We won against an accountant, but it was pretty egregious. The accountant was an S corp. The accountant was an S corp, right? And he was an accountant. He was a CPA. Chose to be an S corp. The S corp made approximately $200,000 in income revenue. He paid himself like $22,000 in wages, and then distributed the rest as distributions, like 147 or 175 or something. I mean, it's crazy amounts of money. And the IRS came in and said, "You have employees." But he's paying himself a $26,000 wage, that ended up being the ship that sunk him. Do you know what I mean? So he was paying his beginning employees and his secretary and everything else more than he was paying himself in wages.
I think he was the only CPA.
He was the only CPA, and he was paying himself like $26,000. So they came in and they recategorized his income, and I think what ended up being is they made him take a wage of $96,000. But I don't know how many years they went back. So changing from $26,000 in wages to $96,000 in wages for 3 years is a lot of payroll tax, plus the penalties, plus the late filing, plus the you know what I mean? So yeah, it affected when that stuff happens, it affects your personal returns, and it also affects, the payroll tax returns. So it was bad. So yeah, this is all like abuses that happen, and I think the IRS slapped him down because they felt like he really should have known better, and he should have known better.
Yeah, he did know better.
He did know better. He should have known better. Yeah, he should have known better. For C corporations, unreasonable compensation is the tax issue. For S corporations, it's the opposite. The shareholder employees try not to take very much wages, and so the IRS will come in and reclassify to reflect higher payroll taxes. They do the opposite with C corporations. They go in and they take out the wages so that it becomes a non-deductible dividend payout. So then the C corp has to pay tax on the income. So that's what they do. And what ends up happening is the IRS could probably clear all this up if they gave us a little guidance, right? Mm-hmm. But there is no guidance. Mm-hmm. There is no guidance anywhere, either in the IRC, the Internal Revenue Code, or in any IRS regulation that tells us what is considered reasonable compensation. They have given us no guidance. And I think the reason why they've given us zero guidance is so they can continue to tag C corporations for this and tag S corporation owners for this. Right? So they can actually technically go in and argue. They're arguing the opposite side of the same argument. Do you understand what I'm saying? It's possible that they're going to go into a C corp and say, hey, you're paying yourself too much, and it's $100,000. And then they're going to go into Julie's S corp, and she might be paying herself $100,000, and they're going to go, you're paying yourself too little for the same amount of money, because they want to be able to argue both sides of the same coin. That benefits them. So there is no guidance, zero guidance about what is considered reasonable compensation. Okay? And that's why this is litigated all the time. Subscribe to PassKey Online for more great content about the Enrolled Agent exam.